This is the Alhambra Investments Weekly Market Pulse with CEO Joe Calhoun. Joe, your piece this week you called Just a Little Volatility.
I was thinking about, I don't know if you remember the movie Major League. Bob Uecker, who was a baseball announcer for the Milwaukee Brewers for years and years and years, played the announcer for the baseball team that was in Major League. And there's this scene where this new pitcher who is played by Charlie Sheen, Wild Thing, they play Wild Thing when he comes in as reliever. And his first pitch is like 5 feet outside and hits the backstop. And Uecker goes,
just a bit outside. He tried the corner and missed.
So that's what I was thinking about when I was writing this title. Just a little volatility.
What I want to do this morning is look at last week's timeline. Stocks were down a little Monday and Tuesday, nothing to write home about. Wednesday was a little hotter than expected PPI, still not much of a change. Why?
Yeah, look, Wednesday PPI comes out, numbers hotter than expected. Market doesn't move. Why? Well, because, Jerome Powell hasn't mentioned that one. Everybody's so focused on whatever the heck it is that Jerome Powell's looking at to make policy that if he's mentioned it ever, they're gonna focus on it. And nobody at the FOMC, I mean, all these speeches they gave over the summer must have been hundreds of them. I don't think anybody talked about the PPI. So what is PPI? It's wholesale prices. Do those not matter? I'm thinking they probably matter quite a bit because they're going to have an impact on the retail side, on the consumer prices that we get in the CPI. But nobody's paying attention to that. Like it's a crazy market where everybody focuses on, in my opinion, in a lot of cases, the wrong thing. But it doesn't matter. The market's going to do what it does.
Well, then we move on to Thursday. The CPI number comes out hotter than expected, and the market goes up.
Yeah, well, you got a knee-jerk reaction down. I mean, you were down 2.5%, whatever the number was, right off the bat, as soon as the market opened. And I think maybe the first trade on the S&P was the low of the day. And it turned around and went straight back up. Well, look, this is what I wrote about a few weeks ago, peak pessimism. Basically what it means, and listen, I will tell you something. There's an old saying, an old thing. Remember, I talk about my guy, Larry Gatto, my mentor, when I got into this business. I talk about him a lot. Another one of his things was, if you don't get the market reaction you expect to the news, then you need to start reassessing. And he always usually applied that to individual stocks. He's like, look, if you get bad news on one of your stocks, on one of your companies, and the stock goes up, yeah, you're done going down. If the stock's been in a downtrend and you get bad news and it doesn't go down, that's a positive sign. So I took Thursday to be kind of positive in that we got bad news. The CPI was worse than expected, the core CPI in particular, and the market went up. Well, that's not what you would expect. And what it really means is that whoever wanted to sell, they already sold. They're out. And we have all this hedging going on. We have a huge amount of stocks, we have a huge short position in the futures market. A lot of people buying puts on the market trying to bet that it's going to keep going down. And you get positioned that way where it's all on one side of the boat, and eventually it will shift back. And sometimes it doesn't even take news for it to happen. And sometimes, as in the case of Thursday, you get news that should knock it down further, and it just doesn't do it because everybody's already sold. That's all it is. It's about sentiment. Of course, Friday was a different story.
Yeah, because Friday we did get the sentiment report from University of Michigan, and that was pretty tame, but it seems like everybody focused on the inflation part of that report.
Yeah, and again, this is one of those things where Jerome Powell actually mentioned this report back at the June meeting, the press conference after the June meeting. So if you remember, let's go back to that time. I don't know if you remember, but the way it was working out, everybody was expecting the Fed to do 50 basis points, and Jerome Powell had prepared the market for 50 basis points. And then University of Michigan Consumer Sentiment Survey has this section about inflation expectations. They have one piece of it that says 1 month forward, and the other piece is long term. I don't know how they phrase long term, what that means, but it's longer than a year, put it that way. And apparently, Jerome Powell was shocked by the 1 year forward inflation expectations going all the way up to 5.3 or something like that. And he famously leaked to Nick Timiraos at Wall Street Journal, who seems to be the Fed whisperer these days, the guy that they called to leak a story, and leaked the story that they're going to go 75 instead of 50. I don't know if you remember, we had just a meltdown in the middle of that month. We had like a 10% drop in the market over a matter of about 4 or 5 days. And it was all based on this thing about the Fed. So at the press conference, he told everybody that this metric, this University of Michigan Consumer Sentiment Survey inflation expectations, is what moved them from 50 basis points to 75 basis points. And I said at the time, and by the way, that was a mid-month read. The University of Michigan does a preliminary reading and then a final reading for every month. And he got it off the preliminary reading. And what was really interesting was that when you got the final reading at the end of the month, actually it was all reversed. So they raised rates based on something that didn't even exist. But since he mentioned it, now everybody watches the thing. And I got to tell you, it's the most ridiculous thing I've ever seen. I laid this out in the article this week, but people are, I will say this, if you look at the poll results and you look at those all the way back, I went back to 1990. I mean, you can go back into, I think, the 60s with this survey. I went back to 1990. And actually the poll is not bad at picking direction of inflation, what it's going to do as far as the direction. Is it going to rise or fall? But man, magnitude, not even close. The average difference between what people expect and what they got was 5.1%. That's not even close. It's not even the same ballpark. So why Jerome Powell would choose this one thing to focus on, I have no clue. But since he's focused on it, everybody else is too. And so the number comes out. It doesn't look good. Inflation expectations went to 5.1 from 4.7. But it's, the thing that gets me is it's still in a downtrend. The peak was in March. So at 5.4 or something like that. But so number one, the number means nothing. Number two, it's still in a downtrend, but somehow people interpreted it to be a bad thing and they sold everything off. You basically gave back in the S&P, you gave back almost everything you got on Thursday, you gave back on Friday. And by the way, I'm looking at the market this morning. Yeah, we just got it all back this morning. So that's where we are. It's just volatile as hell.
Well, let's talk about the Fed a little bit more, because also on Thursday, we had a 6% move in the bond market. Is the Fed going to jump on top of that? Do they think they need to get involved now?
Well, let's be real clear about that. Listen, I kind of did this. I'll be honest. I did it for dramatic effect. We didn't have a 6% move in prices on bonds on Thursday. What we had was the range of interest rates for the 10-year Treasury note was in a 6% range. I took a little license there. Okay. I'm trying to make a point. The bond market has been extraordinarily volatile this year, and it makes sense. We don't have as much liquidity in the bond market. Listen, I was told many, many years ago, and I remember I'm not a finance guy. This is not I didn't come to this naturally. I didn't go to college and get a finance degree or anything. I was in engineering. But when I got in this business again, Larry told me that volatility is the inverse of liquidity, meaning that if you don't have any liquidity, you're going to get a lot of volatility. And if you have plenty of liquidity, you'll get none. And in a sense, in some ways, that's what bull markets and bear markets are all about. When you don't have any liquidity, you get big moves in the market, just like we're getting right now. So that move in interest rates in the 10-year on Thursday was really what drove that rally. Because in the morning, based on the CPI number, the 10-year spiked up to 4.03, I think it was, or 4.08. And it traded down all the way to 3.84 later that morning. And that's what spurred that rally. It was also that the rates coming down like that also brought the dollar down. And so those two things, rising rates, rising dollar, has been kind of the headwind for stocks all year. But in the bond market is where the volatility's really been. We haven't even seen the VIX, which is the volatility index for the for the S&P, for the market stocks, hasn't gotten over 40 yet. And we usually see bear markets, even cyclical bear markets, you usually get a spike above 40, but we haven't even seen that this year. It's been despite the fact we're down 25%, the market's been pretty orderly. But boy, the bond market has not. Bond market, the MOVE index, which is the VIX for the bond market, is at 152. Now, look, you got way above that in 2008, but this is not 2008. But we're above where we got in 2020. And I don't know if you remember, but man, bond markets almost froze up in 2020 when COVID came on, and we've got a MOVE index that's above that. We're above where we were in the 2003 bear market a little bit, not a whole bunch, meaning that, look, lack of liquidity is something that happens. That's what happens. That's why the Fed's tightening. They want things to tighten. They want liquidity to be less abundant. But the question is how much? And when you start getting disorderly moves in the treasury market, I think you got to start paying attention. And I think more importantly, the obvious reason for them to have higher volatility and lower liquidity right now is quantitative tightening. It's just exacerbating the situation. Now, I don't believe, because there's no evidence of it, that quantitative tightening or quantitative easing has any direct impact on inflation. So if the Fed's mission here is to stomp out inflation, why are they doing quantitative tightening? It really doesn't have anything to do with it. I think what they need to do here, and listen, I'm not the only one. A lot of people said this at the beginning. Why are they trying to do both of these things at the same time? Why are they trying to hike rates and shrink the balance sheet all at the same time? Hell, they don't know what one of them does. Put the two of them together, they sure don't have a clue what the two together do. But what I can tell you is that we've reduced the liquidity in the treasury market to the point where we've got volatility that really, it can cause some problems. Look, bond markets are not supposed to be that volatile, and we use bond markets to set rates and all these other markets, mortgage markets, all these other things. And you start those things to moving around a lot, and everybody downstream is affected. And it has a big impact. It can have a big impact on the economy. Look, I'm not saying the Fed's going to get involved. I'm not saying they're going to end quantitative tightening. They probably won't, because Jerome Powell seems to have no clue what the hell he's doing, and he's going to keep doing it. But I would say that Janet Yellen did point out last week that she's concerned about liquidity in the treasury market. Now, look, I don't give Janet Yellen credit for much. I thought she was an awful Fed chairman, and I don't think she's much better at Treasury Secretary. But she is right that there is some issues with liquidity in the treasury market. So we'll see what happens. I do think that Yellen has some influence over Powell. I will say that. She's the whole reason why the Powell Fed is so focused on unemployment. She was Fed chair, and she's a labor economist. Surprise, surprise. The thing that she wanted to favor when she was Fed chairman was labor statistics. No kidding. People are going to do what they're best at. And she was a labor economist, and so she focused on labor. So that's why Powell's probably doing it too. So she does have some influence there. If she'd whisper in his ear and say, maybe you ought to back off, maybe he would. But I'm not counting on it, put it that way.